Okay, let's get started. Hey, today we've got a very special guest who's going to help us understand what's happening in the market of Bitcoin. Now, it's been pretty much choppy for more than a year now, almost a year at least. And a lot of people have very different opinions on what's going on. Is it a bull market? Is it a bear market? And, what defines either of those categories? And TXMC Trades has been kind enough to join us today and give us his read of the market. And needless to say, none of this is intended to be financial advice. So we're just having a nice discussion here, and you're free to make of it what you will. TXMC, are you there, mate? Unmute your mic, and it'd be really nice to hear from you. How you doing?
Hey, how you doing, brother? How's my audio?
Yeah, you sound perfect, mate. It's nice and clear, coming through nice and clear. Hey, look, I guess I really want to start this off at quite a high level. And I don't want to be as glib as bulls and bears, but how do you see the sentiment in the market at the moment?
How do I see the sentiment? Well, that's an interesting question, and I think sentiment is really powerful. And my read of sentiment recently is that it's extremely fragile. Now, I know that there are definitely, a lot of positives that we could see in like the fundamentals for Bitcoin in terms of adoption and growth and like that super long-term perspective that we know is exorbitantly positive. But sentiment right now is extremely fragile, and it makes sense, right? I mean, we're 5 months into a market downturn, and it came at a point where we were getting the world was shocked by some high inflation prints near the end of last year, and the party kind of came to a quick and abrupt end for a lot of market participants. And when I see months of this kind of price action, and anytime we have a pump of any size, I mean, we could have a single 4% green day, and people on Twitter are going crazy. They're glomming on to any kind of positive, little ingredient they can find. It really feels to me like a market that has been absolutely beaten into the ground, and that people are looking for glimmers of hope and for any kind of optimism that might give them some solace and some peace of mind that the bottom isn't going to fall out of their investments. And I'm not just talking about Bitcoin, I'm talking about everything. But with Bitcoin specifically, I think one read that I have in particular is that I think that there is an expectation of a certain percentage of people, and I'm not going to say they're wrong or right, but there's an expectation, I think, that people have that because Bitcoin is a risk-off asset by design, because of its sound money properties, that it's ready to take the mantle and decouple from an otherwise deleveraging and downtrending global market. And in my opinion, is that we're not quite there yet. So I think that while sentiment is fragile, Bitcoin itself is kind of along for the ride with what we're seeing going on globally.
So you mentioned Bitcoin fundamentals, in particular adoption and growth. How do you measure those, or which KPIs and metrics do you look to?
Well, when I say those things, one data set that I look at pretty frequently, I look at on-chain data. Now, some of it's useful and some of it isn't. But when you look at activity, just raw activity, because I mean, Bitcoin at its core is just a ledger, right? It's just a list of a bunch of transactions. And from that very basic profile, we disseminate a bunch of investor behaviors and we break them down. But at the core of it, it's really just party A and party B transacting in the native unit, right? And so when you count those things over time, the number of transactions every day, the number of unique addresses that are participating in activity over time, like month on month, quarter on quarter, those things are growing over time. And so that's one way that I measure adoption. It's an imperfect science. I don't like to look at market cap because that can be misleading. But when you just look at transaction counts, active addresses, Glassnode has something called active entities, which is just a smoothed version of transactions and addresses. All of those metrics are generally up and to the right over time. Now we go through these phases, Archie, these phases of bull and bear, where in a proper bull market, like in the parabola of 2017 or in the beginning of 2021, there are deviations above the normal up and to the right growth of these active addresses, this network activity. And when we have those surges, the rate of change grows tremendously, and there's these big spikes of activity on top of what is already kind of a growing triangle. And so those are moments where you can really see the network kind of breaking out and decoupling from its normal year-over-year growth. And like I said, we did see that at the beginning of 2021, and coming into March and April of last year, before the market top actually came in, activity by this measure that I'm using was already declining and suggesting a weakening market. And so I think that is a really core aspect of just gauging network health. Is activity growing over last month and last quarter? If not, is it declining? And if so, is that being reflected in price?
So, I mean, just looking at a very high level, I can see the volume hasn't really recovered from last summer, well, the last northern summer anyway. It's been trending low and it has pretty much stayed low. Now, you mentioned activity, which is a really interesting thing to pay attention to. And I wonder how much the changing nature of participants in the market will influence the level of activity. So we're seeing so many more hedge funds and institutional players who are really interested in Bitcoin for it as a trade as well. And perhaps their purchasing activities might be different in nature to how some plebs might buy it. I mean, a pleb might buy whatever they're going to commit to it in a few transactions, whereas an institution might do that over hundreds or thousands of transactions. Do you think that has an influence at all in the level of activity, or are you seeing, or can you see metrics that can decipher who's doing what and separate that out?
So there are some ways to disseminate the activity more granularly. It's not something I focus on a lot myself, but like groups like Chainalysis, they're very good at that. But to answer your question, the first question, so there's two different things going on. I mean, on the one hand, the sizes of transactions is growing. So like the volume, the percentage of daily transaction volume that is consumed by transactions that are worth more than $10 million USD has grown in the last year and is a considerable amount of daily transactions. I'll pull up the chart while I'm talking here. And part of that growth, part of transactions being worth more, is the nature of number go up, right? But also it's showing a growth in the size of economic activity that's happening, like on a per transaction basis. It is growing, and it's growing at a higher rate than the market cap is growing. So it's showing larger players entering the space and transacting on chain. But to add a little more context to kind of what you're asking about these players and how they might break up their buys, I think there's some definite validity to that. You're kind of describing like a TWAP strategy where a large purchase is broken up into a bunch of smaller purchases that are executed over time so they don't disrupt the market. There's a lot of that going on, but also something that I think is important to keep in mind contextually when we look at on-chain data specifically is the nature of the way the ledger is being used and the way that economic activity for Bitcoin is being done is changing over time, and it's not all happening on the base layer. There are certain types of institutions now that have high net worth clients, that have sophisticated investors. These institutions have their own local treasuries of Bitcoin, and they have credit lines established with certain exchanges. And they have credit lines established with certain exchanges. And they have credit lines established with certain exchanges. And they have credit lines established with certain exchanges. And they have credit lines established with certain exchanges. And they have credit lines established with certain exchanges. And they have credit lines established with certain exchanges. And they have credit lines established with certain exchanges. And they have credit lines established with certain exchanges. And they have credit lines established with certain exchanges. And they have credit lines established with certain exchanges. And they have credit lines established with certain exchanges. And they have credit lines established with certain exchanges. And they have credit lines established with certain exchanges. And they have credit lines established with certain exchanges. And they have credit lines established with certain exchanges. And they have credit lines established with certain exchanges. And they have credit lines established with certain exchanges. And they have credit lines established with certain exchanges. And they have credit lines established with certain exchanges and they can perform transactions for their clients with that exchange. And the only activity that we would observe on the ledger is the P&L difference between those credit lines. So there's a certain level of economic activity that we just don't see in its clear and obvious form by looking at the mempool and watching the transactions going through and breaking that up into the various on-chain data that a website like Glassnode uses. And so I'm not saying that transaction stuff isn't useful going into the future. It absolutely is. But my point is that the nature of the way the ledger represents an economic activity is changing. And over the next couple of years, more and more meaningful economic activity may be taking place that we don't even see. We're just seeing kind of the remnants of it. And so that can make observing growth and adoption above the individual level more difficult, because individuals, they're transacting on exchanges or they're doing peer-to-peer transactions on chain. Their behavior maybe isn't changing as much as these other groups I'm describing.
Wow, that's a really profound point that you just made, and it's sort of I've got about 5 questions that have popped into my mind. So essentially, these are kind of over-the-counter style trades, but you're saying they're facilitated by institutions that are large enough, that have the infrastructure for custody, transaction, and P&L management, that large
Right.
investors can actually conduct transactions of significant size off-chain, so that we don't actually see the Bitcoin change beneficial ownership or addresses, and we can't track that, but the service provider tracks all of that for them. And so the Bitcoin doesn't have to move from a particular address if they've got some kind of inventory management system or trade management system internally that recognizes who owns what at any particular time.
Right. And what you're describing is essentially how the exchanges work for average investors, right? It's a closed box ecosystem. You put your coins in there, they conduct any number of economic activity, and then when you leave, they parse out some amount of the treasury that is owed to you and you leave, right? Those coins that you leave with aren't necessarily the exact coins you walked in with.
You just have a
on
claim
the
to
ledger.
whatever's in that pool, and your
Right.
service provider. Yeah, go on. Sorry.
No, absolutely. You're right. And that's the way you described it, though. That is the way that it functions in places like Fireblocks, like Copper, like other institutions of that nature. Are these types of businesses I'm talking about? And over the last 18 months, that industry is exploding. And so every quarter, there's new businesses like this, and that's part of the reason that I think that exchange balances are on a multi-year downtrend.
Yeah, absolutely. And that was my next question, is that kind of renders our analysis of on-chain data concerning some metrics to be completely redundant. Well, not completely, but at least highly unreliable, especially on exchange balances as well. So, for example, Glassnode does have a metric, or it passes many metrics by entities, and I wonder, does it have the ability to identify by entity, by service provider, the size of the pool of BTC it holds, and perhaps to be able to divine or guess some kind of guess as to what the size of this off-chain sort of market, shadow market, is? Because at the moment, I don't see anything like that, but I'm not a non-chain analyst. I don't dedicate myself to this sort of thing. I'm not a data scientist either, and I wonder if Glassnode has any sort of endeavors like that.
Well, identifying entities on chain is an extremely complicated process that I think far too few people have an understanding of or respect for. And it's something that really I started to understand when I was working for Glassnode. I did work for them for a few months, and what I came to realize is that when you see these exchange balances listed on a website like Glassnode or like CryptoQuant, those addresses that they have assigned to Coinbase or to Binance or whomever, there's no like official repository of Coinbase's addresses, where you can just go as a Glassnode business and pluck them out and assign your metrics to them to follow them. That information is crowdsourced by other analysts. Either the Glassnode can create bot. I'm using Glassnode as the example because that's the business I worked for, but CryptoQuant is doing this as well. Many others are doing this. In some cases, they create a bot that deposits money to an exchange, transacts, and then withdraws, and then they go look on the block explorer, line that up with some addresses and go, okay, that must be Coinbase because we just withdrew from Coinbase. And so you can see how it's a very kind of bespoke process. It can be very painstaking. And from business to business, like from CryptoQuant to Glassnode to Masari to Skew, they may have slightly different methods. So there could be a fair amount of overlap, but there may be a couple of addresses that are missed by one site that are caught by another. And so I'm explaining all of this because it in part answers your question, that we can't 100% know what the size of all of these exchanges, which addresses correlate to their balance with 100% certainty. We can just have a confidence level about it. And it explains why there's differences in exchange balances between different websites that provide that information. But also, it's why entities that aren't these major public businesses like Binance and Coinbase and Kraken and FTX, those are easier to find this information about because you've got thousands of people trying to identify these addresses and doing these processes, and they work together. And once you find one business that's identified Coinbase, maybe there's a confidence level with that. And so Glassnode, maybe they use those addresses as well. It's a little bit of teamwork involved. But when you've got new businesses coming up every quarter, like I said before, Fireblocks, Copper, these places like this, we have no idea what their addresses are. Someone may know, but they're not sharing it publicly. They're not posting the charts on Twitter. And so there's a black box of this information. And it's extremely difficult moving forward as this ecosystem grows and matures and more of these businesses spring up. Continuing to track them on the ledger is a gargantuan task, and I do not envy the professionals whose job it is to do that.
So how does price discovery work in these parallel markets? Do you have any insight into that? Because, if you're having all these over-the-counter transactions, which one leads which? I mean, because we don't know what the volume is in that parallel market compared to what I guess I could call the on-chain public markets. Do we have any insight into which is leading which?
I don't have direct insight that I would be confident in sharing with your audience, but if I had to speculate, this is just me speculating based on what I understand, I would assume that these businesses use an oracle of some kind that is provided by one of these existing exchanges, some kind of arbiter of truth, whether that's the BitMEX oracle or Coinbase or whomever. So that's my assumption, is that they have someone helping to make a market for them.
And if there's a discrepancy between the two, I'm guessing there's also many who are taking the opportunity to arbitrage that as well.
Right. It's the same yeah, exactly. Yeah. That's the same reason why all the exchanges follow each other pretty closely in price, a lot better than they used to, is because of market makers arbitraging the differences and creating liquidity.
So when we look at a singular metric like exchange balances, that can be assumed to no longer really reflect the intention of market participants as it once perhaps may have.
I would say yes, in a way, Archie. I think if I can call you Archie. Sorry, I know you said that was your name.
Yeah. Go ahead. That's good.
Cool. In a way, yes. I wouldn't say it's completely useless, but what I would say is that the continual outflow of exchanges that is ballyhooed on Twitter is probably not as meaningful as people say it is. It's, detach the romantic narrative from it just a little bit. Now there is, you can make the argument, well, we're not seeing inflows to exchanges, so that states something about investor behavior. And I would agree with that.
It might state something for perhaps mostly retail investors, though, right?
Right, I would say so. Yeah. So what I at this point in time, what I'm kind of looking at with exchanges is I'm looking to see an influx, a deposit of exchanges in mass at a point in time, and its context with price. Because absent that, we're kind of just continuing the same multi-year trend. It's not really providing signal.
Yeah, because I mean, I can see when I pull up some metrics on Glassnode, and particularly the balance exchange or liquid supply, there is still kind of I wouldn't say a loose correlation, but there is a pretty good correlation there about highly liquid supply or supply going on and off exchanges in any meaningful sort of trend. It does tend to reflect in the price sooner or later. But I guess not having visibility of these parallel pools of Bitcoin capital, it's a little bit like when Greg Foss talks about the capital structure of equities with respect to bonds and equity as well. And it's if you're not looking at with debt, if you're not looking at the debt, then you're not going to really understand what's going to happen with the equity, are you? And so it's kind of like, well, if we can't see what's happening off chain, and the suspicion is that this is becoming a larger percentage of the transaction volume, and if we can look at what the drop off in transaction volume has been since when are we looking? Since April last year, and the increase in these types of businesses and these types of services appealing to institutional capital, we've got to start assuming sooner or later, and please correct me if I'm wrong, that a lot of the activity and perhaps even the leading activities happening off-chain or within these services. And what we end up seeing is when that activity drives the price up, it leads to a sufficient enough volume of retail interests, and the Google searches go up, and we all start getting boosts on our followings and whatnot, and they're the sort of manifestations of a retail mania taking hold. So I'm kind of like, now that you've told me all of this, and it's made me sort of sit back and take stock of that, I'm like, how much of the market do we really understand at the moment, do you think?
Well, I think that's an interesting question, and it's becoming more complex. It was prior to the 2017 bull run, really in through that period, from before the peak in 2018, Bitcoin was predominantly peer-to-peer, right? There were a couple of exchanges, many of them rose and fall in the early years. And Bitcoin itself was the trading pair of the alt market, right? Like the stablecoin ubiquity was not really a thing. BitMEX hadn't come around yet, so we didn't really have derivatives. The market was much simpler, and the majority of economic activity happened on the base layer. And so we had a very clear representation of the whole of the ecosystem, or as much as you could at the time. Now, granted, on-chain data didn't exist in its current form back then. So we didn't have people like myself looking at the data I'm looking at now. But nowadays, because of everything I just described, with stable coins now existing, with multiple stable coins, with multiple exchanges, with a very robust and deep derivatives market, with all of these new businesses that are coming on that have these credit lines with the exchanges that we're talking about. Additionally, all the other OTC activity that goes on, almost every exchange now, all the big ones, have their own OTC desk. And what I don't know is how much of those balances are visible to us when we look at OTC desks and exchange balances. So there's a lot of activity that we just don't see. And we can infer certain trends and certain behaviors based on the activity we do see. But I think that there is a muddying of signal. And I think that in many cases, the data I see people presenting on chain, on Twitter, particularly stuff like illiquid supply, I think is vastly misunderstood and misinterpreted as some kind of a strong bullish signal, when in fact, to me, it just looks like a byproduct of a network maturing and growing away from the base layer.
So can you explain that a little bit more? I certainly have posted a lot of those metrics myself, and not understanding what you've just explained to us, have obviously not been giving an accurate picture of that. But look, I don't push myself out there as an on-chain analyst either. I mostly share information for the sake of discussion and like, oh, isn't that interesting? So could you elaborate
Sure.
a little bit on that for us, please?
Yeah, I'd be happy to. And again, these are just my views. You may find another analyst that thinks that maybe I'm missing an aspect here, but I've spent quite a bit of time studying this. And so I feel pretty good about my views on this. And my view on a liquid supply is, so for those of you listening who don't even know what I'm talking about, illiquid supply is meant to represent the Bitcoin that sits with participants on chain that have a low propensity to sell. So those addresses that are holding that Bitcoin that we're calling illiquid, meaning not liquid, they have a low history of outflows. The majority of the history, whether it's one transaction or many transactions, is inflows by a factor of 3 to 1. So those people are hodler types. They mostly deposit. Outflows are minimal, all the way down to zero. And we when we're talking about illiquid supply, it's analogous to the hodler supply. It's the opposite of highly liquid supply, which is supply that's constantly moving. These are addresses that have a lot of outflows. Exchanges are highly liquid. But illiquid supply is the one that gets shared the most. And the reason I think that it's misunderstood is because of, in part, the maturity of investors on the Bitcoin chain, because of best practices, privacy practices growing in popularity. So, for example, if you have a ledger and every time you withdraw from an exchange, you use privacy best practices and you create a new address and you withdraw to a new address, and then you don't move that Bitcoin anywhere, the Glassnode entities do not know that that new address belongs to all of your previous addresses. And that new address has no outflow history. So I'm not, whether you're a hodler or you're not a hodler, my point is that if every time you withdraw to a new address, that new address doesn't get used again. It never gets clustered with any of your other history so that we can create an entity profile for you. Every one of those addresses is considered illiquid because it's a brand new address with one deposit and no outflows. And we know nothing else about you. And so every time one of these new addresses is created, if it happens to not be touched again, it's just assumed to be an illiquid entity, even if it belongs to a trader that is performing a ton of outflows. But just because of the nature of clustering algorithms, that address never gets linked to them. So there's some noise in the data. And when you have a lot of people transacting in a short period of time, it can cause illiquid supply to rise quickly, because that metric is powered by clustering algorithms that take time to identify these entities on chain. So when you see something that is an entity metric from Glassnode, for example, I'll use them because I'm familiar with their data, like long-term holders, illiquid supply, anything that says entity adjusted in the metric, those things take time to bake in. And you can see data one day that 2 or 3 days later has adjusted a bit. And so really it takes a couple of weeks for those things to bake in. And so I'm explaining all of this nuance. I mean, maybe some of y'all's eyes are glazing over a bit, but the point I'm trying to make here is that these metrics contain so much nuance. They are not as clear as, oh, this is hodler supply and it's going up, so that means everyone's holding their Bitcoin, no one's selling, we're going to have a supply squeeze. That's not how simple. It's not that simple. That kind of narrative, I feel like, can be dangerous. And I've fallen prey to that myself in the process of learning and growing and understanding this more. I've fallen prey to some of these, what I would consider, inaccurate narratives. And so illiquid supply going up is a good thing. Sure, it's a good thing. But again, similar to exchange balances, it has a tendency, by the nature of the ledger and privacy practices, to drift up and to the right. So what I'm really looking for with illiquid supply is for it to reverse, because that would demonstrate a change of behaviors. That would show that a bunch of addresses that haven't been fucked with in a while, excuse my language, are suddenly having outflows. Whether that's because they were properly identified or not, all the noise and hairiness I just described almost doesn't matter, because suddenly a bunch of addresses that weren't moving are moving. So that's the signal I look for there. And an absence of that is almost no signal, I would say, at this point in time.
So the metrics are put together using a bunch of inferences and data science techniques. They're not 100% known. Like the taxonomy of every single address and what they are and what they're doing is not known with certainty. There are many inferences made to come up with calculations and the like, and to define each metric and come up with a value. And just to be clear to everyone who's listening who doesn't have access to Glassnode, this is not a secret that's being revealed. They do have pretty good documentation and brief explanations under every chart. So, if you do have the mind to go down and read what it's all about, I think you can. I mean, this is not a Glassnode advertisement, but I think you can create a free account and you get sort of limited access to some of these KPIs and metrics. So if that's what you want to do, by all means, do it, or Crypto Quant as well, or any of the other.
Yeah, there's also there's free data on Coinmetrics.
Coinmetrics is another one.
Free community data. They've got a big CSV of data you can download for free. And all these metrics I'm describing, this research is publicly published, as you were just describing. So all this stuff I'm explaining, I read for free on the internet. I don't have any bespoke information that's closed off to the public here.
Yes, I just want to, make it clear to her. This is not like a grand expose. I'm talking to someone who's, dedicated to understanding these things. And thankfully, he's sharing his insights. And we don't all have the time to go through and read every metric and understand how they interrelate with one another, what the market structure is like. So that's the point of me having a space like this and a guest like TXMC. So I just wanted to make that clear, because sometimes if people don't know, it's kind of like a big revelation, as though it's we're uncovering some kind of conspiracy to mislead people. But it's not that at all. It's just people are making best efforts. But, we may not all. And I've certainly learned many new things in this short half an hour session so far. So I just wanted to clear that up in case those sorts of thoughts are rattling in some brains. As you know,
and I'll
go on.
Sorry, go ahead. Yeah, well, this is an imperfect. It's an imperfect science in the first place, and when it really comes down to it, we're taking, as I mentioned in the beginning of our conversation, a really simple thing like a ledger of transactions, and we are extrapolating extremely complicated investor behaviors over a decade plus now, and so there are a lot of ways that we will get these things wrong, particularly as the metrics are being created in real time and tested in a real-time environment, right? Like on-chain analytics that we're talking about here, as its current form, is only a couple of years old. And it's really not even seen a full market cycle. So there's going to be a lot of metrics that come out that we realize maybe a year or two later aren't as useful as we thought, or they just completely fall out of relevance because of changes to the ledger. Who knows? But this is just kind of part and parcel of exploring a new field.
So I want to get into some of the changes with respect to understanding the market a little bit later on. Having already, I guess, put a massive caveat on on-chain data and analysis, I do still want to talk about some metrics with the understanding that they're not perfect. Because on-chain behavior and what they tell us about market structure is still kind of an important narrative to form, whether, albeit it's not a precise one in our minds. So I'm wondering how you see that at the moment. Who's accumulating? What kind of hodlers are dominating? Is it short-term, long-term? The nature of, or the size of market participants. Where is the supply coming from and going to? Who is holding it? So is there distribution? Is there accumulation? That sort of thing. How do you read those sorts of metrics at the moment?
Right. And we can get reads on those things. Like we just spent half an hour talking about caveats, as you said, but there is still value here, and we still can interpret what's going on the ledger.
Yeah, just because something isn't perfect, it doesn't mean we discard it completely. It's just we need to be mindful of the imperfections of what we're looking at.
Precisely. I mean, RSI is an imperfect metric, but people use it every day to make trades. So it's just about understanding your tools. And so with the current state of the network, it's really interesting because the last calendar year or so has been an unorthodox market for Bitcoin. Now, we did have a double pump bull run in 2013 that people often refer to. And I don't think that what we are seeing now is some longer version of that. I had that theory briefly many months ago, but no longer. And what I'm seeing now, so in the beginning of 2021, in late 2020, the market ran up from the previous all-time high of 19K up into the high 40s at the beginning of 2021. And that whole move there was very much exactly like previous bull markets in terms of investor behavior. So what do I mean by that? So in a bull market, there are a couple of things that happen. It's not just that people are buying more than they're selling. That's obvious. But when you have true market strength, when you've got increasing activity, like we spoke about in the beginning, when you that year over year growth, the rate of change of it explodes. And you see things like active entities creating a mountainous peak on top of their growing year over year trend. That kind of demand brings in a lot of spending of older coins. So people that have been sitting on the network that have held their Bitcoin for 2 or 3 years through these gruesome bear markets that it is known for historically. When bull markets begin anew and we find ourselves in price discovery, meaning we have broken into new highs and we're agreeing about new values, those moments, when you look back through history, are when long-term holders, people who have held their Bitcoin for 5 or 6 months and beyond, that's when they come to life. They tend not to spend their coins in weakness. They predominantly spend them in these periods of strength. And so when you look at the 2017 bull run, and when you look at the late 2020, early 21 bull run, both of them have the same marker of volume increasing, transaction counts increasing heavily, and long-term holders spending into market strength, realizing gains, supply changing hands to newer investors until it reaches a point where the market rolls over, right? Supply overpowers demand and we have a fall. All of that stuff played out exactly as it normally does at the beginning of the year. The only difference is the market didn't end when that activity fell off like it did in the previous bull markets. Usually when you reach the peak of activity, when you reach the zenith of spending, all that stuff, you get the parabola that everyone knows, and then price collapses, 60, 80%. Well, we didn't get that. We did get a drawback from 40K down to about 30K in January, and then we spiked back up to 50. And in that little pullback there in the middle of January, that was the market top. That was the absolute highest point of activity on chain for Bitcoin. It was the highest amount of volume. If you look at like Coinbase transaction volumes, which is not on chain, a lot of activity spiked there in January of 2021. And what happened after that was really a decline in market strength, but we got the Elon candle. At the beginning of February, we found out that Tesla had Bitcoin on its balance sheet. And at that point, derivatives started going crazy. We'd already seen an increase of leverage and open interest, people transacting in the derivative space during the bull run that was growing. But it really went crazy when we found out that Tesla had Bitcoin. And it helped to propel a kind of Bart Simpson looking rollover top that played out through February, March, and April. And by the time Coinbase's direct listing came around in April of 2021, the market had completely run out of steam, and that marked the Pico top for like 6 months. So I'm describing all of this because I want to describe to your audience what a bull run looks like. High activity, older coins realizing gains into market strength, paying themselves for taking on risk and waiting, and new investors finding themselves at the top of a market that is rolling over. All those things played out. But what happened in the second half of the year was the unorthodox part. So
Before we
we
get on to
rolled
that,
over.
I just
Yeah,
want to
yeah.
ask you
Please
before
interrupt.
we. So you're calling the peak of the bull market in January, when we then went on to make further highs because of the market activity that we spoke about right at the very beginning of this session. Market activity peaked, but you're saying then there was subsequently the hype from Elon Musk and
Hmm.
the activity that kicked off in the derivatives market, or perhaps that was coincident, who knows? But
Yeah,
you're saying that hype and that activity then propelled the price to new highs, but the activity in terms of trading volume began to fall away in the months after that. And then
very
eventually
much so.
that manifested in price weakness and we saw the massive dump.
Very much so. And
Okay.
so the 2020 and 21 bull run ended at a couple of major events. So the 40K peak in January was the height of activity. I'm sitting here looking right now at my active entities chart, and
Yeah.
the Mount Everest peak was literally in January. And that was also the end of the grayscale arbitrage. So the GBTC fund had a major premium where traders were locking up GBTC and trading the arbitrage to like 20% premium there. And that premium dried up at the end of January of 2021, beginning of February, right around the time that we found out about Tesla and Bitcoin. So the spot pressure, the actual physical locking up of Bitcoin that helped to drive price from the low teens in 2020 all the way up to that high, that dried up, that premium dried up, and people stopped trading GBTC in February. At the same time that derivatives leverage skyrocketed, particularly on Bybit, started going crazy. So, and all these 100 and 125, 150x apes that thought Papa Elon was going to take them to the moon, they all started getting absolutely rinsed. And if you look at February and March, those were the highest months of liquidations ever, like in USD totals. It was crazy, and it carried on into May until the market collapsed. And we've never seen that kind of leverage since. We've seen high open interest. Derivatives are still very common, but that kind of leverage hasn't returned. That kind of just crazy aping. And
So when I look
yeah,
at
feel
the
free to
great,
interrupt. Yeah.
sorry, go on, finish what you were saying. Sorry.
No. I was just going to start explaining the second half of the year, but I'll
Oh,
pause
okay,
here.
yeah.
It sounds
Just
like you have a
before we get
question.
on to that, I've got one more question. So when I line up the Grayscale Bitcoin Trust, the chart of that against the Bitcoin price chart, you can clearly see, when Grayscale pretty much closed off their trust, the Bitcoin price pretty much has been trading within a range from there. You think which one do you think led to the other? Do you think the price led to the Bitcoin Trust closing off, or once they closed off, the price took a dump?
I think it was them closing off. And I don't fully understand all of the ins and outs of the grayscale instrument. It's a very complex instrument,
Well,
and
can I add this? I did ask
yeah.
them. They invited me onto one of their spaces I did, and I had the assumption that they closed it off in preparation for their Bitcoin ETF application being approved. Apparently, that
Mhm.
was a mistaken assumption on my behalf. They said they closed the trust because of the net asset value was lower than the market value of all the Bitcoin they held. So why would investors buy the trust when they could just buy the Bitcoin? So
Right.
yeah, I guess I'm
Yeah.
sort
Right.
of
When the
answering my own
premium
question there.
Yeah, when the premium dried up in the middle of February, it was about 2 weeks after the Elon candle. So they in that 2 week period of time, there was the culmination of the end of the grayscale arbitrage,
Hmm.
of Tesla entering the Bitcoin mined space, and maximum derivative aping in futures for Bitcoin. All three of those things happened in February and March, while network activity, the kind that drives a bull market that we spent so much time exploring a few minutes ago, was in heavy decline. So that is my thesis about the market top in April.
And
Spot was long gone.
So I have a little bit of a suspicion that's sort of brewing now, because it was also at that time there was a large British institution that disclosed that they'd essentially sold a position of, I think, 500 or 600 million plus, and it was also around the time that Tesla disclosed they had also sold 300 million, around about $300 million. What information did these people have access to that we didn't, or is it just a coincidence that two major institutions sold in the hundreds of millions opportunistically at or near the top of the market?
I don't know. You may be tapping into a little bit of the tinfoil hat arena
Well, I
there. I
open
don't
that
know.
only for discussion and interest,
Of
rather
course,
than
Fred. Of
pointing a
course.
finger at anybody.
Yeah,
But
it is curious, isn't it?
no, I'm curious because in light of our earlier discussion about the parallel markets, or closed pools of Bitcoin capital trading by service, with service providers, and I'm just wondering, well, is that giving others some insight that's leading the market that we don't have access
Possibly.
to?
I mean,
Yeah.
maybe they saw the GBTC premium drying up and they figured they would get ahead of whatever headwinds were coming to the spot market. That's I'm just speculating, just
Yeah, I
grabbing
mean
at
that's all
something.
we
But
can do, unfortunately. Yeah, it's so,
right.
but sometimes it's worth just putting the question out there into the consciousness and see what comes back. So, all right, let's get into
Exactly.
the second. Let's get into the second leg, because yeah, I interrupted you as you were sort of leading onto that.
No, no, it's all good. And so, excuse me. The second half of last year, the market was really beat down in the summer, June, July. We had the B word conference where Kathy and Elon and Jack all talked about Bitcoin and everyone got really excited. And that was the actual bottom of the summer, which is hilarious. And after that, a short squeeze in derivatives helped propel us off the lows. So some traders that had bet on price to go down with some leverage got caught on the wrong side. And so their closures, their automatic closures became buy orders and helped push the price up. And we had some return of spot demand, a small amount of it, when the price started to reverse in August and September. But by the time we got to early September, leverage had built back up in derivatives again. It was more powerful than the spot demand at that point. And so what happened on September 7th? El Salvador made Bitcoin legal tender, and we had a massive 10K red day because over leveraged traders had bought the news. We sold the event and flushed. And just like in April, when the Coinbase direct listing marked the absolute pico top for multiple months, the high in September was again a jubilant event that was built up and bought into by traders and sold on the day of the execution. And so that period to me really showed the market didn't have a lot of strength. And I remember tweeting, though I didn't fully understand it then, and I've come to understand it better in the months following. I remember tweeting in October, wow, we're heading towards all time highs, and this is the quietest the market has ever been in terms of spending volume, in terms of what I would consider demand, which is growing activity, growing growing activity on chain, growing volumes in spot markets, like those kinds of things were not happening. But we still saw a lot of derivatives, the futures traders, just pure speculation. And that was really what helped to push us up towards all time highs because once again, it was excitement about the futures ETF launch. If
So
you
when you
recall,
mentioned,
that was
sorry,
the
when you
day
mentioned
before the all
traders,
time high. Yeah.
sorry to interrupt you. This, I think
No,
it's got a bit
please.
of a lag, and I keep speaking over you when I want to say something. Sorry about that.
No, no.
When you mention traders, are you talking about professional shops? Are we talking degens, or are we talking just anyone who's got a short-term focus?
Anyone who's got a short-term focus. That was really they have really been in control of price action for many months now because retail, just pure spot, I need to own physical Bitcoin. That kind of demand has been very mild. Us on Twitter, us Bitcoiners who are very active in being Bitcoiners, we live in a little bit of a bubble, and we are not the majority. That we are a very powerful group. We are very dedicated to our craft, but we are not the majority. And so our passive DCA purchases is not enough to create a bull market, right? And so when we have any kind of consistent and demonstrative pressure in the derivatives market, it overpowers spot when we're in these kinds of markets. And the whole second half of last year was the same kind of market we're in now. Like in terms of volume, in terms of demand, it's more bearish now. But the level of activity isn't really much lower than it was in October. We just managed to make an all-time high because most of the people that wanted to spend had spent just a few months prior. The market hadn't fully reset itself. It wasn't ready to be back at all-time highs again. We hadn't built conviction among the holders that had bought just a few months before. They weren't ready to sell. And so you asked a question a few minutes ago, and I know I take a long time to answer, so I'm sorry for rambling, but you asked a question, who's spending, who's accumulating, etc. And who's spending right now are people that bought their coins 9 to 15 months ago, by my estimation. The people that are the newest long-term holders. Because the reason I say that, we have a metric called long-term holder supply that measures the amount of Bitcoin that hasn't moved in 5 or 6 months and longer. And we choose that time because statistically, that is a period of time where spending is very low. Like once you hold your coins for half a year, the chances of you spending them on a given day are very low, statistically. So we call those people long-term holders. And when you look at the supply that that group owns, which is a very large percentage of Bitcoin, it's like 70% of the supply or so, that supply has gone flat since October. And why does that matter? Well, long-term holder supply is kind of always gaining new members because every day there's some amount of Bitcoin that's just sitting around that hasn't been moved in several months. And on that day, it gets to graduate into being long-term holder supply every day. But what we're seeing with the actual metric, long-term holder supply, is that it is sideways. It is flatlined. It looks like a dead person on an EKG. And what it's showing you is that every day, those coins that I mentioned that are getting older and they're graduating are being offset by existing long-term holders that are spending their coins. So those coins are leaving that group and they're becoming young again and their lifespans are being reset. And so when I see a flatlining of hodler supply at a period of the market that we're in that should be very bearish, when we should be seeing mass accumulation, when we should be seeing long-term holder supply going up and to the right because most people are just sitting on Bitcoin. Instead, we're seeing it flat and sideways, which is showing that people who got into this market 9 months, 12 months, 14, 15 months ago, because of a few other metrics that I'm looking at that I won't go into too much because it'll probably glaze people's eyes over. But there's evidence that shows that these people who are spending, they have cost bases that are very close to the current price, meaning they're not old hodlers. They're not hodlers from early 2020 and 2019 who have cost bases around 10K or 4K or 8K. They're people with a cost basis at 35,000 or 46,000 or 52,000, and they're spending now. And those people are joined this market in the 2021 mania. They have not built conviction, and they are now spending their coins. And so that is very bearish to me. It's not a red flag, but it's something that I believe people should be a little bit concerned about if we're actually able to find a bid here, if we're actually able to start constructively building out of this 40K basin, which we have been setting higher lows. It's taking forever. We are still setting structurally higher lows, as hideous as it is. If we actually manage to start climbing towards 50K and into the retrace levels, I think that some of these people that I have been describing to you may provide overhead pressure because they are not the diamond-handed hodlers that we are used to having. And part of that's because we've been stuck in the same price range for a calendar year, and it's really close to the all-time high.
So, what kind of a role do you think derivatives are playing in influencing the sentiment in the market? Because I've got no visibility on what that size of the market is. I haven't really looked in depth into it. So, do you have any insight you can share into the size of it and what sort of influence you think it might have on the spot price?
Well, I think it has a huge influence on the price. The derivatives market is gigantic. It's many, many billions of dollars. Traded volume alone is tens of billions a day. I don't have the number right in front of me. I'll try to pull it up here. But the thing with the derivatives that make it tricky is that it can grow completely untethered to Bitcoin's own adoption, right? Like Bitcoin, you could put Bitcoin, freeze it, and put it away for 20 years. And the derivatives market could continue to grow as people speculate on what they think Bitcoin's going to do, right? Because it's paper Bitcoin. Now, your position is collateralized with physical Bitcoin in some cases, but in many cases, it's collateralized with cash. You don't have to have a single BTC. And that whole market is growing very quickly. There's very little friction to creating new instruments. You just need to find someone to give you some liquidity and put it out there to the traders, right? That space can continue to grow. It will continue to grow. And I think that it's something that it's not a bad thing for Bitcoin to have derivatives, because in a way, it helps to relieve some of the hedging pressure that would normally get applied to physical Bitcoin, right? We have a lot of sophisticated market participants that are looking to expose themselves to a highly volatile asset for the first time. And rather than hedging themselves on physical spot Bitcoin, they can hedge themselves with derivatives. And the effect it has on the market is slightly different. And so I think that it offers more complexity in the different ways people can expose themselves to Bitcoin's price action. They can express their bias without necessarily selling physical Bitcoin. But it can have a huge impact on the price because of its liquidity. The Binance Tether-based perp, the perpetual future, the BTC USDT perpetual future on Binance, is absolutely gigantic. It's a third of the entire derivatives market for Bitcoin. And it's one of the most liquid instruments on earth. And you could trade it at any point in time, and there's billions of dollars flying through it. And that market is hugely influential on the price of Bitcoin on a given day. And so I've been paying a lot of attention to derivatives. When we go through these phases of adoption, where we have another like proper bull market and a bunch of people suddenly realize that Bitcoin is pristine collateral and that they need to own it, rightfully so. When we have one of those moments, spot price will decouple a bit from derivatives. But as soon as spot demand starts to dry up, derivatives will take over again, as they did in October, as they did in the early part of 2021, and as they currently are in control.
And so why would you think that an investor would prefer futures over spot at the moment? How would that, I mean, I know you mentioned hedging before, but can you give us an example of a situation in which a futures, Bitcoin futures would be better for their objectives than a spot would be?
Well, I guess it depends on what you're trying to do. Many traders are just trying to realize fiat gains, right? And they want to take a leveraged bet, and they don't want to necessarily use their physical Bitcoin to do it. So futures allows you many options in that regard. You can play in derivatives like in the options market and just bet purely on volatility and not even take like a price bet. It allows a lot of different ways of expressing your bias about the market. So I think that the appeal just depends on the trader themselves. Like I said, there's a lot of traders that aren't necessarily in it for sound money, right? They're just in it to make fiat money, make fiat gains. So they don't really care. They're going to go wherever there's the best leverage and the best liquidity, and that is the derivatives market. It's not the spot market.
Okay, well, so we touched on derivatives, and I want to talk to you about correlations because, I mean, we've had this narrative in Bitcoin for quite some time that, it follows the halving cycles and whatnot. And, other people post charts and say, well, actually, we're very tightly correlated to the S&P or the NASDAQ, or have a look at the DXY. Whenever that's gone bearish, Bitcoin has gone bullish. And, they're pretty tight correlations, actually. So I wonder what's your view on that. Perhaps if we can start with the dollar basket, if you've got a view on that.
Yeah, I don't have a strong view about Bitcoin's correlation to the DXY. I think the DXY is kind of a misunderstood instrument as well, because it's a weighting of multiple currencies, right? And a lot of times when people see it going up, they assume that means the dollar is winning against the world, when in a lot of cases it's because some member of the basket is absolutely tanking. Like recently, it's been the Japanese yen. I don't have a strong opinion about Bitcoin versus the DXY, because in all honesty, I don't look at those two together very much. But I do look at Bitcoin and equities quite a bit. And I think that the connection there is, in my view, inarguable and obvious. And I hear a lot of people, coping. In my view, it's cope, trying to argue that Bitcoin is not correlated with equities. But if you look back through history, every bull run for Bitcoin has happened alongside appreciation in the major indexes. Crashes have happened at similar times with other big crashes. Many of them have, including the 2018 bottom falling out of the floor from 6K to 3K. The NASDAQ did the same thing that day. So there's a lot of parallels between these two things. And part of it has to do with the fact that Bitcoin has existed in a secular 10-year bull market of liquidity. And it's now coming, that liquidity is starting to dry up. I think the correlation is pretty clear. Now, intraday, it may not be. Bitcoin is a 24-hour market. It gets an opportunity to react to world events before U.S. equities do in many cases, because they only trade 6 hours a day, 5 days a week or something like that. So they have a very tight window where those investors get to express their concerns and their emotions, whereas Bitcoin is 24 hours a day, every day of the year. So those correlations can be tricky to line up. But I remember just a month or two ago, I posted a tweet where I was looking at Bitcoin and the S&P on the CME futures, which trade at the exact same time. So there's no issue of, well, Bitcoin's moving over the weekend and the S&P is not, because that throws off correlation tests. If you run a correlation test on TradingView, it's going to count those times and it's going to say they're not correlated. But if you look at the CME futures and you look at Bitcoin and you look at ES, the correlation's very high. And it's been even higher since March of 2020.
So that sort of raises another interesting point about correlation, because as we see an influx of institutional capital, that's going to be influenced by institutional culture and mindset as well. So, if they're suddenly liquidating everything because of how they view the world and markets, how is Bitcoin conceivably going to escape that? I guess I put that to you as a question. It's kind of a rhetorical statement as well. Or will it be able to escape that? Because I wonder how, if it could, because we build up these narratives to ourselves or amongst ourselves that Bitcoin is or will become an uncorrelated asset because of its properties. But historically, you've just mentioned, regime of high liquidity in the world. All asset prices have been driven up, including equities, real estate, certain commodities and whatnot. And so as we're seeing more and more institutions who are like-minded coming into Bitcoin now, how is Bitcoin, or will Bitcoin escape their, I don't want to say culture, but their herd mentality when it comes to risk management in certain times in the market?
Well, I don't think it will. We wanted institutional adoption, and now we're getting it. And what it's doing is it's making Bitcoin more correlated to traditional markets. We can't have it both ways. And you bring up a very good point, because I am not a big believer. Narratives can be powerful and they can drive sentiment, but I think narratives can be misleading as well. And the romanticism of Bitcoin narratives, I think, get in the way of us having just kind of honest conversations about market realities sometimes. I'm not in this for the dogma. I'm in this for the best money possible. And right now, that's Bitcoin. And so that's what I'm here for. I'm not here for dogma. I'm not here for a movement. And the thing I think gets caught up, and you mentioned it, because of Bitcoin's properties, it is a risk-off asset. It's pristine collateral. But the thing is, it's 13 years old, and it's competing against a fiat system that is 60 years old, and against a shiny metal rock that's thousands of years old. And I think that we're still a good ways away, maybe throughout the rest of this decade, before we could be at a point where the properties of Bitcoin and the narratives that drive people's adoption of it because of those reasons overpower traditional market effects. They're
Yeah, so
very far away from that happening.
we don't see adoption yet. We're nowhere near adoption being at saturation point yet, where people start to think of, where first of all the price has appreciated enough to reflect that, and there's some level of maturity that we're seeing, or what can I say, stability in the price movements that we're seeing,
right?
So that people begin to see it
more
much
stable
more
than it used to be.
Oh, okay. You mean on what kind of time frame do you think?
Well, I mean, I think the price is more stable than it used to be. The dollar values that are fluctuating are higher than they were. But I mean, we just went through a bear market and it was only a 50% drawdown. An old bear market would be 80%. And then it would immediately have a 70% reversal and then fall 50% again. Like within
I
a
could
month,
argue
right?
against that, though. I could say, yeah, but a bull market might have been 30x instead of a 10 or 15x, right?
Right. Well, the stability goes both ways, right? And when it's instability to the upside, no one minds. But generally, the asset is stabilizing over time. The ups and the downs are truncating, wouldn't you say?
Okay, fair enough. I guess also thinking from a traditional investor's point of view, a 50% drawdown is is difficult to accept as being more stable than anything.
Right? Yeah. We have institutional guys in here who think a bear market is a 20% drawdown in an index.
And then they'll remember it. Yeah, they'll remember that moment for decades, and they'll tell their grandchildren about a 20% drawdown and how they lived through it.
Right. Yeah, and I think that while we have these institutional guys here, until we reach one of those events, which I believe will come in the next few years, we will have a breakaway moment of adoption. It might not be the moment that causes the hyper Bitcoinization narrative, but we will have another moment, a huge surge of adoption. And I think it will happen when the market falls in on itself. But I don't know that we're quite there yet. And I think that, barring something like that, Bitcoin will probably go through these de-risking phases along with risk assets in equities, because we have a lot of the same people trading those things.
Yeah, I mean, I've sort of thought about a few different scenarios under which sort of mass adoption or nation state adoption is going to play out at scale. I probably am leaning towards how it sort of happened with a lot of high net wealth individuals, where many of them bought early but quietly and didn't really say too much. And a lot of them spoke disparagingly of Bitcoin for a long time until the moment of disclosure. And I suspect something similar will happen, where a lot of larger countries may begin to flirt sort of quietly with accumulating Bitcoin, will continue to be disparaging of it, and then one of them will sort of come out, or it will leak or something like that, and then a few others might sort of let it fly and disclose that they also have a holding. I don't think there's going to be this huge announcement and, okay, guys, we're off to the races now. The United States has declared Bitcoin sort of, it's going to be a bit like how they announced the aliens to us, where people have forgotten. Like, it was only 18 months ago that they did that. And it's like, we've forgotten that already. And they did that during a pandemic. And I think announcing a Bitcoin holding by the United States is going to be a little bit like that. So let's see what happens. I wonder if you have a view on that, how you think that might play out. Do you think it's going to be sort of this official policy to embrace Bitcoin by the United States? Because we've seen already by this Biden administration, as Michael Saylor has described it, really we couldn't have expected a more bullish statement from Biden with his executive order and then Janet Yellen's subsequent speech. So, but, you know, it hasn't really, the Bitcoin community hasn't really, how can I say, they're not really all that excited about it because the price is in the doldrums, right? So, but I see a lot of changes that's going to generate down the track. So I wonder how you see it happening with respect to the United States. I'm assuming you're American or live in America.
I am, yes. I'm in Texas. It's something I think about. I don't know if I don't know if I'm satisfied with how well-rounded my answer is on it. You know, it's something I want to think about some more. But my view is simply that the United States is the least incentivized sovereign on earth to adopt Bitcoin. The least incentivized, because their currency is currently the one that the world revolves around. And so until that ceases to be the case, they have no incentive to open their minds to an alternative currency that might drain capital out of their own markets. I don't think that they're incentivized to do that. There is a game theoretical, aspect to it that we're all aware of, but that doesn't necessarily mean that they'll be privy to it or take advantage of it. I think that nations of the ilk of El Salvador, who are, in the emerging market category, that are least benefited by the current system, are the ones most incentivized to change it. The same way that those least benefiting from the current oligarchy are the ones most incentivized to adopt Bitcoin on the individual level. I don't think the United States is anywhere close to being friendly to Bitcoin from an embracing it standpoint. I don't think they'll try to regulate it away because of the possible wealth destruction that it would bring, and they've already openly, numerous times positioned themselves to view Bitcoin as a commodity rather than a security. So I believe they'll be consistent with that. But in terms of the U.S., adopting it in a more formal way, I think that's probably very unlikely. I think it's more likely that they try to cozy up to stable coins to regulate the industry down to size a bit and create more room for their own CBDC Fed coin in the future. I think that's their angle. I think that they don't take Bitcoin seriously. And the only people I see so far taking it seriously are politicians whose constituents have a libertarian bent. Cynthia Lummis, Ted Cruz, those people whose voters are telling them to give a shit. Those people are the ones talking about it. But I don't know how far we are away from that reaching the executive level. That's something I think maybe will take some more time.
Yeah, I find myself agreeing with pretty much everything you've said. Interestingly, I have been reading more recently about some people advocating for Americans advocating for the US dollar no longer to be the reserve currency and the various benefits, but they're also stridently Bitcoiners as well. So they've got a huge self-interest. But I don't really rate the strategic abilities of the current political regime or any political regime emanating from the White House actually of late. I think they're just doing things out of convenience and not really understanding the broader consequences of what's going to happen down the track. Hopefully, there is a bureaucracy under all of that has a little bit more depth and nous to it. Hey, listen, you've been fantastic today. Really appreciate it. We've been going just over an hour and 15, and I wonder if you'd be open to taking some questions from the audience.
Sure, I'd be happy to. Let's do it.
All right, guys, if you've got a question, just or a comment, please make a request, and we'll bring you up on stage in just a second.
Okay. I see a lot of my homies out there listening. If you guys want to come up here and tell me how wrong I am,
yeah, don't be afraid.
I'd love to hear from you.
Okay, so go ahead, Luke. When you get a chance, just unmute your mic and we are ready for you.
Luke, My man,
Yo,
what's up?
TXMC, how are you, man? Um,
Go ahead, Luke. What's your question or comment, mate?
yeah, right. I don't normally disagree with my man TXMC, but I'm gonna have a crack at this one. I actually think the US is backed into a corner so badly that I think they're the country that needs Bitcoin the most. And faith in US Treasury debt is at an all-time low, and everybody's losing faith in the dollar like they were in the 1970s. And I just think in the 1970s, the US had to pull a rabbit out of a hat to retain their global reserve currency status, and they sent Nixon.
You're breaking up.
Oh, sorry. Is this any better now?
Yeah, it's much better. Go ahead.
Sorry, dude. I don't even know where I cut out. I was just going to say, essentially, the US needs to pull a rabbit out of its hat. In the 70s, when everybody lost faith in the dollar, the US backed the dollar by petrodollars. They made the Middle East price their oil in dollars. And I think maybe the US has to do something similar today. And I don't think they can back the dollar again with gold, because I think China's sitting on 20,000 tons of gold that they're not going to declare. I think Russia is the most backed fiat currency, dependent upon the amount of gold they hold. So if the US backed the dollar by gold, I think that would shoot themselves in the foot. So I'm hypothesizing, I'm speculating. As a Bitcoiner, I'm more hoping, but I think the US might really pull a rabbit out of a hat here and back the dollar by Bitcoin a lot sooner than most people think. That's my crazy tinfoil hat conspiracy theory, and I just think. I got another whole theory, but that'll take another hour. I'll leave that for another day. Thanks for having me, guys.
Okay, thank you, Luke. Power and Bitcoin, we're ready for you whenever you're ready. Are you there, Power and Bitcoin? Okay, we'll just move over to who else have we got? Okay, Nagona. Are you there, Nagona? When you're ready, just unmute your mic and go ahead with your question or comment. Okay. I might bring up Mohammed on stage and see what he has to say. Mohammed, when you've got a minute, unmute your mic and go ahead.
Yo, hi. Hello. Good morning.
Hi, Mohammed. Go ahead.
Hi. Actually, I got a question about the. You already asked that question. It was about the correlation about the Bitcoin and S&P 500. I like the answer actually. When TX said that back in the day, we hoped that big institutions and big companies to invest on Bitcoin, and we all wish that back in the day. But right now, since the COVID pandemic, it's at the end of it, and we got the vaccine and we got everything, and life is back to normal. We saw that Bitcoin moves and act differently. It's not a safe haven like before, where we won't put our money there, run away from inflation and all that stuff. It's not kind of question. It's just we need to open our eyes a bit right now. Bitcoin is not like before. It's not moving the way we want. It's not made for the way we for. I think there's a lot.
So that's okay. So look, that's an interesting question and comment actually, because in March 2020, when the markets crashed in response to COVID, most of the central banks in the world responded with a massive program of printing money. And at that moment, their narrative had pretty much emerged that this is going to lead to inflation. And so what a lot of Bitcoiners do, they plowed into Bitcoin and continued buying Bitcoin all the way through until late 2020, when we started seeing the price appreciate significantly. So from the low of about 3,000, it was sort of teetering between 9,000 and 12,000 for a time, for many months. And then it gained some momentum in late October, and then we saw the bull run going on. And so if you take that time frame to the top of the market, that was when Bitcoiners essentially got their hedge on inflation. It wasn't at that point, inflation hadn't been evident in the official numbers, but pretty much everyone in Bitcoin was expecting inflation to manifest sooner or later in the official numbers. By the time that actually did happen, where the bull market had sort of run out of steam, we'd already seen the drawdown last summer and a run up again, as TXMC has already detailed for us. And so now, as we are seeing the peak, well, hopefully the peak of the official numbers, but at least they are peaking. And people are looking at Bitcoin to say, well, why isn't Bitcoin responding right now? Well, the answer to that is Bitcoin has responded because the people who have been buying Bitcoin as an inflation hedge have been doing so since it was 3,000 to 6,000 in March 2020. So all the way from then up until it hit the peak of the market, a lot of people were actually hedging for the anticipated inflation. So TXMC, I wonder what you have to say about that. Is Bitcoin an inflation hedge? If not, has it changed since the 2020 and 2021 sort of bull run? And do you expect it to respond in any particular way if inflation numbers continue surging higher?
It's an interesting thing to think about. So it's a bit of semantics, but I don't know that Bitcoin is a hedge against inflation so much as a hedge against debasement of buying power. Now, sometimes that can come through inflation. Right now, we're dealing with inflation. But monetary debasement is happening all the time, even though we're not always dealing with high rates of change in consumer inflation, which is the topic we're having right now. And so I think it is absolutely a debasement hedge because of its inelasticity to demand, because of its fixed supply. We know those things. And I would say that it has responded very well over the last couple of years to these concerns about inflation. The realized cap, which is the price at which all coins last moved on the chain, on the ledger, the realized cap, which is like the cost basis of the network, it grew from about 100 billion in March of 2020 to currently 467 billion. So it tripled essentially in 2 years, the cost basis of the network because of inflows to Bitcoin, because of people wanting to own the asset. So it has responded. But one thing I would add is that I'm not 100% subscribed to the idea that the reason we ran from March through whenever is because of inflation. I think it's because of QE. The bottom of the market in March, the Pico bottom of the stock market was the second of a pair of announcements of QE by the Fed, after which point everything went straight up for a year and a half, for a year basically. And when we started to see the market running out of steam in the second half of last year, it finally rolled over when we got those awful inflation prints in November and December. That was like the end of the market. And so I think that inflation itself scares people away from things they perceive as being volatile, because there's a lot of people that don't understand Bitcoin's properties. Those of us who do understand it, we plowed our money into it. But there are a lot of people who still don't. They still see it as a risk asset. And I have this conversation with Bitcoiners all the time, but it's true, and we need to admit it. Most people see it as a risk-on asset. It is a risk-on asset for, I don't know the percentage, probably 3/4 of the people who own and transact in Bitcoin on a given day think of it as a risky asset. It still behaves like one. And its properties, and this is kind of goes back, Archie, to what you and I were talking about earlier. There is a disconnect between its actual properties and benefits and its current perception by the market. And those things will take time, I believe. And we are currently experiencing the first true monetary crisis, palpable monetary crisis in the Bitcoin era. And so this event that we are going through now will catalyze future adoption. This will be an event that people learn from because they haven't yet learned. This is the moment they learn.
Okay, DJ Satoshi, go ahead with your question or comment, please.
Hey, thanks so much, Archie. Really huge fan. Really appreciate you hosting, and thanks so much for giving me the opportunity to ask this question. TX, also a huge fan of you. Thank you, guys. So it's actually, I had another question, but you guys kind of already covered it. But I'm going to ask the question that you guys just touched based on, which is like how Bitcoin is still perceived as a risk on asset. So what is your opinion on when you think people are going to realize that it's a lot more than that and that it's not really a risk on asset?
It's tough to answer. Hey, what's up, DJ Satoshi? By the way, you're in Spaces a lot, and I always appreciate your perspective. So glad to talk to you. That's a tough one to answer, and I think part of what it's going to take is just pure size. I mean, Bitcoin grew to $1 trillion asset faster than anything in history, but its total addressable market is exponentially larger than what it is now. Its total addressable market is money itself. It's not going after some other tech name. And so it is very early in its growth cycle, even though it's been 13 years. And I might not have a clear answer for you about. I think that this kind of line in the sand, this number, whether it's the market cap of gold, that's what a lot of people use as kind of a benchmark. Maybe it's 10 trillion. I don't know that it necessarily has to get to be that size. Maybe it just needs to double or triple from its current size. I think we're getting there. I mean, just think about it. Bitcoin was a $126 billion asset in March of 2020 by market cap, $126 billion. And now it is $700 billion. And that happened, during a period of liquidity, obviously a high liquidity environment, but also, during a period of monetary crisis. It has grown tremendously in just those last couple of years. And these last couple of years are when these narratives about it being, a future monetary asset of the world really started to take shape just in this last couple of years. And I know a lot of us are really eager to know when it will achieve kind of a greater potential that we know it's capable of and it's headed for. And I think we've just got to be patient with it. This is the first step of many large steps, and the world's just waking up to it. I think, though, it's probably going to require, and I hate to say this because I'm not a doomer. I'm actually a pretty optimistic person, but I truly believe that most market participants learn through crisis. They can't be taught beforehand all of the right decisions to make. People learn, unfortunately, through pain. And I think that it will be a collapsing of financial markets that drives the true adoption phase. I don't want that, but I think that's what's going to take.
Okay. Thanks
Yeah,
for your.
absolutely. Is it okay if I ask another quick one, Archie?
Okay, go on, mate.
I appreciate it. Thank you. So, do you foresee a time when we can no longer trade, fake money for real money, like fiat into Bitcoin? Do you foresee that that'll happen? Like, seeing how Michael Saylor is, one of the biggest starters of the attack on the dollar, which I'm a huge fan of Michael Saylor, so don't misunderstand the point. But, do you foresee time when governments are going to be like, okay, you know what, we can't let this keep happening, and they're going to kind of chomp down, and maybe that's kind of where they're introducing CBDCs so that they can have more control over where the money flows? Do you foresee that ever happening with Bitcoin?
Yes, that's a major concern I have over the next decade or so. I tweeted about this the other day. A CBDC future is a panopticon. It is not an environment that anyone should desire for, and it's a playground of control for the powers that be, and they are highly incentivized to discourage fiat liquidity from flowing into things like Bitcoin. Now, I said earlier, I don't think that they can try to destroy Bitcoin because it would destroy too many Americans' wealth. But I think that they can try to heavily control and tax the ramps on and off of the fiat highway. And I think that they've only begun to exercise their abilities in that regard. I think that when we get closer to the CBDC future, that the fight over how easy it is to convert dollars into Bitcoin within the domestic borders of the United States is probably going to become more difficult. I'm only talking about the US because I don't want to speculate on what I think other countries are going to do with their money, like the EU. I don't live over there, so I don't know all the intricacies. But I do think that the federal government, the Federal Reserve, Washington, D.C., all the politicians, that their entire incentive structure relies on, fiat hegemony. And so they in lieu of just outright destroying people's wealth, because prohibition tends not to work, I just think that they will try to heavily tax and control people's on ramps and off ramps. And at that point, the people who have been stacking in a sovereign way for the years leading up to it will be in a much better financial position than those that have, either through complacency or ignorance or a potpourri of both, they have allowed institutions to maintain custody of their coins. That's why it's so important to withdraw your Bitcoin into self-custody whenever possible. You can see what happened to the people in Canada when they were protesting, the truckers up there, what happened to their Bitcoin and everything that they fucking dealt with just a few months ago. That should be a stark awakening for anyone who is trusting institutions to have their back. You can lose it in a heartbeat. It is not your coins if they are not in your custody. And so that's a long answer there, but generally, yes, I'm very concerned about that.
Excellent. Thank you so much for your time.
Thanks, DJ Satoshi. Next up is Matt. Go ahead, Matt C.
Matt, what's up, bro?
Okay, you're with us, Matt. Just unmute your mic. We can't hear you if you're speaking. Go ahead.
Hey, thanks, Archie, and hey, thanks, TXMC. It's good seeing everybody. A lot of familiar accounts in here. I just want to take a second to say, it's amazing, man. I mean, I jumped in late, but TXMC, the way you articulate all of your thoughts and take your time with it, it's admirable, man. It's just so many thoughts and so many complex ideas put simply is a hard thing, and I don't think anybody understands how hard that is. But I just want to take a second to say that I'm really just a chart guy, so I can't really say much about the narratives or all what's going on in the news. But a couple of things that I want to agree on that you mentioned is that I do see on that the charts do validate that the equities are correlated heavily with Bitcoin as a risk on asset. One major concern is that I'll break it up into a few sections. We've never seen Bitcoin, since it's so young, go through a 2008 or 2000 kind of drawdown, like a 50% drawdown in equities during these times. So my first question is, what would you expect Bitcoin to do as a risk on asset if equities continue lower?
Oh, well, it's absolutely going to take a haircut. I mean, if the S&P falls 20, 30%, Bitcoin's going to fall 50%. I firmly believe that. If we wake up and the S&P is below 4,000, it's very possible Bitcoin's in the 20Ks. That's going to be the first reaction, because it's, in all honesty, guys, it's not that hard to push the price down if enough people sell. It isn't that hard. The liquidity is broken up across all the exchanges. I mean, they are closely linked together in price because of market makers and things. But if you just release some big orders at the right time of day, you can shove price down. And in a panic moment, when markets are collapsing, you hear this phrase a lot. It becomes a correlation one moment. Correlation one meaning everything is linked. Everything is moving unilaterally in the same direction. It's what March 2020 was, right? That was a correlation one moment where all markets crashed. And that will happen again. When indices go down, whenever it happens, it will happen at some point in the future, whether it's months or years from now, they will crash again. Bitcoin will crash a greater percentage by percentages than the indexes. But I also think that due to its inelasticity, that it will rebound quicker than any of those others, just like it did in March of 2020. That was a preview of what those events can look like.
All right. Thanks for your question, Matt. I
No,
really
thanks.
appreciate it. TXMC, I can't thank you enough. That was absolutely fantastic, man. I really appreciate you coming on and putting on a great performance. You've been very informative, taught me a few things in such a short time, and I'm very grateful for that. Thank you very much, man.
Well, look, I'm glad to be here. I'm happy to come on and talk anytime you want to, mate. Also, Matt, you said some really kind words before you asked your question. I didn't respond, so thank you, brother. It really means a lot to me. And I'm just glad to be here.
Thanks, guys. I think we'll call it a day, and thanks everybody for tuning in. Bye.